Welcome to Sumax. My name is Kelvin Moretti. In this week's episode, we'll be discussing money and specifically basics of investments in money markets, bonds, and everything in between. Hope to have you till the end. Karibuni sana. I'm joined by a very knowledgeable panel. I'll let them introduce themselves.
Thank you for having me. I'm very excited to be here. My name is Faith Kwamboka. I'm a portfolio manager in one of the largest asset management companies in Kenya.
Is it one of the largest or the largest?
The largest.
There you go.
Also, thank you for inviting me. My name is Billy Ouko. I'm an audit associate in one of the big four accounting firms in Kenya.
These people are so humble. Billy is an economist and anajifanya hapa sijui accountant sijui nini. Anyway, yeah, so today as I've mentioned tutakuwa tunaongelea about investments. Kwamboka, so I saw something that was saying that storing or saving your money in your account, you're losing that money. What does that mean?
When you put your money in a savings account where you're earning 0% or even 2%, basically if you're earning anything less than inflation, this last month in August was 6.5 or 6.57%, so 6.6%. So if you're earning anything less than 6.6%, you're basically losing money. It means if you are able to buy bread for 50 shillings this year, next year, so if your money is giving you 0%, so next year you still have the 50 shillings, but then you will not be able to buy bread because bread next year will be worth 50 shillings times 1.06.
So essentially one should be able to put their money somewhere at least, kupatia 10% and above.
Yeah, so first of all, you want to put your money where you're able to store value or at least maintain the value that you have, and then earn some return that is above inflation.
Okay. And one of the most interesting things I learned is that the millennials, we are very bad at saving. And we are, even as a country, 5% of Kenyans have savings that can be above 100,000 or something in those lines. So what do you think is a problem?
I mean, I wouldn't be shocked if those numbers are right. I've seen studies that show 90% of Kenyans live above their means. And that is, so of course, if you're living above your means, it means you don't have, or you're not saving anything. You're borrowing to live. And that's concerning. I've seen people who borrow to do different things, essentially just basically living above your means. So we don't have a saving culture, and that's a problem, because you're essentially you're essentially assuming that you'll be able to work for the rest of your life and be able to afford the kind of lifestyle that you're living now. And the reality is that's not true. You might not be able to work for the rest of your life. And if you're always borrowing to finance your living, then there's a big problem.
How big of a problem are we talking about from a country's point of view? No, I would say a generational point of view.
The consequence that might come out of this is we'll have a lot of old people, because we're growing, we'll have a lot of old people having to work into their old age. So you wouldn't have the benefit of retiring at a young age. You wouldn't even have the benefit of retiring at 65 if you're not saving. You might find yourself in a situation where you have to work for long, and then also you'll find people who then depend on their children, and that's a problem, because then that means that my child has to work to finance their living, and they also have to finance me, and that's a big problem.
Is it part of the reasons why hii history inaitangwa the black tax? We were discussing with Billy a while ago, vile it's usually as an African, I don't know if it's an African thing, but kuna kuanga na there, you have to budget some money to take care of your blackness. Like they are all these, yeah, not they are called family. But I'm just saying. So is that Billy? Dependency ratio.
It's what Faith has mentioned. Is the ratio of income earners to non-income earners, at least in a family unit setting. That is, you'd find that the dependency ratio in Kenya has been going down thanks to the economic growth we've been experiencing over the last decade or two. However, given that there is poor saving and investment culture, especially among the huge portion of the population, you find that the family unit will have one breadwinner supporting a lot of people. And as time goes by, as people move out of the working age, that is 18 to 65. That is as people retire, and then we have kids also. So you have kids on one end and parents on the other end. The burden on the people between 18 to 25 who are actually working, when you factor in the employment rates in Kenya or the unemployment rates in Kenya, that ratio is bound to grow.
And maybe let me tell you what that would mean for our economy. So, of course, if the dependency ratio is high, it means I'm spending a lot of my money on people, on expenditure and I could have been spending this money on investments or something that would have had a bigger effect on the economy and the growth of the economy. So I could have been saving this and maybe using this money for a different purpose or a business or whatever. So if you have a high dependency ratio, it means a lot of your money is going into recurrent expenditure. You're left with very little to put into investments and that would allow the economy to grow. So from a country perspective, having a high dependency ratio then really cripples how the economy can grow.
I'd also like to mention that, our saving problem is partly an income problem because our per capita income ranges between 100,000 to 140,000 per annum. That is, the average Kenyan makes 12,000 a month. 12,000 a month is not much. Yeah, it's just will sustain their consumption needs, but not investment and saving needs. Yeah.
Yes, but now you see at the end of the day, I think when it comes to running a country, whether you have little income or not, the objective of any nation, or essentially when you're trying to lift people from poverty, is increasing investments, increasing opportunities or creating capacity for people to be able to invest, and it's what has happened in China. China, by and large, is it's the second biggest economy in the world in terms of their GDP, but at the same time, it's classified as a developing. You said it was developing. What was it called? Emerging economy. So and so. What that means is that yes, their incomes have not gotten to the level of Europe and in the Americas, but there is an increasing middle class, and it's all thanks to aggressive investment, private and public. And so even with a small income, as you're saying, Billy, I think we need it's very, very important that investment and capacity for investment be at the center, of the focus of whoever is in leadership. And that's why I tell people I think Uhuru has done a very good job, because this always gets stones thrown at me.
Yeah, I appreciate what Billy has said. The fact that people are not making a lot of money in our country. But maybe the focus of this discussion could be the people who can actually exactly. And by the way, we're not saying that you can get away with it if we're not saying that you have to earn a certain amount of money for you to put aside some money for investment or to secure your future. But we want to be in touch with the reality. The reality is there are many people who have a lot of dependence. So we're just saying, well, it's upon you. It's within your discretion to say, I could spend what I am earning up to this much and try as much. I think what we want to do is we want to encourage people to save as much as they can without necessarily pointing a finger at you if you're not saving, because we are we understand that people are really struggling.
So now what do you do? So Faith Kwamboka, what do you do at
I am
this investment, this biggest investment firm in Kenya?
I don't think we're the biggest investment firm.
Okay.
We're the largest asset management firm.
Okay, fine. What do you do?
Yeah, so I am an investment professional. My role is to grow people's money. So in my current capacity, the bulk of our assets are pension assets. So if you are employed, your employer will give you pension benefits where they contribute a certain amount every month. And so that money goes into an account. And so it's my responsibility to invest that money so that by the time you're retiring, you get a good amount of payout. So you're able to sustain your current
living standard.
Yeah. Well, not entirely, because you can't entirely depend on your pension. But basically, the whole point is we're managing these funds to make sure that it's always growing, so that by the time you're retiring, you get a good payout.
Yeah, what is your portfolio allocation?
That's proprietary info.
No, but
I could tell you
speaking,
the universe.
So
we primarily deal with capital assets and property. So that is to say that I will not come to you and give you advice on how you can buy a car and put it on Uber, or I would tell you how you can buy cows and then you'll get milk or whatever. So only we deal with capital assets, and then we also deal with property. So within our investment universe, or at least in our country, we have fixed income assets. Those are treasury bonds issued by the government, treasury bills issued by the government. We have corporate bonds issued by different companies. And then you also have corporate papers, which is an equivalent of a treasury bill. So the difference between a bond and a bill is just the tenor. Bills are less than a year, then bonds are longer than a year. So that's our fixed income assets. Then we have equities or stocks. Those are corporates listed on the Nairobi Securities Exchange, Safaricom, EABL, Equity, etc. And then we have, within fixed income, we also have deposits, which you can place in banks. And then we have another class of assets called alternatives. So under alternatives, different things can fall into that. You can have property, you can have private equity, you can have venture capital, you can have cryptocurrency, FX trading, etc.
Okay, that is very interesting, because we had a discussion with some classmates of mine concerning investment in government bonds. How good an opportunity is it, and what are the basics of getting into it, and what are the returns look like?
I feel like we've skipped a step. We're here because I believe many people don't have a lot of information on how to make the most out of their money. So I can't tell you the number of friends I have who keep their money in a savings account. So I guess what I'm trying to say, we're basically here to encourage people to remove money from savings account and put it in higher yielding assets that would give you a better return and for the same amount of risk that you're willing to take.
So you mentioned earlier that, and also Kevin has also alluded to it, the fact that when you're storing money in your account, you're losing that money. So what would you advise someone? Like, what kind of opportunities exist that someone might be able to, now stop losing this money and at least get it at inflation, or at least an investment that gives them inflationary returns, and at the same time also if you can be able to grow it to the next level?
I'd first like to say that information is power, and I find that most of the time the reason why people have a lot of their money in savings accounts is because either maybe they think investments is too complicated, or they're lazy, or they just want to park money somewhere and then invest it in something else. But the reality is that in the meantime you're losing value. So information is key. That's number one. And then number two, it's also very important for you to be clear on your objectives and on your ability on your risk tolerance. So it's very important for you to be clear on your objectives and your risk tolerance. Objectives meaning what do you want to achieve? Do you want to save money for a certain thing? Or do you want to save money for retirement? Or do you just simply want to make a good return over a short period, etc.? You need to be very clear on what your objective is. And then you also need to be very clear on what your risk tolerance is. Risk tolerance meaning how much of this money can you lose? How much can you afford to lose? I know people who have and that could be a function of many things. It could be a function of how much money you have in your portfolio at the time of investment. So if you have a lot of money, it means that there is you have a higher ability to take risk on a portion of that money. But if you only have 10,000, and maybe this 10,000 is for your wedding, the reality is you might not afford to take risk with that 10,000. So you have to be clear on your objectives and you also have to be clear on the risk that you're willing to take on the money. But I also want to say that many people would equate a riskless investment to savings in a bank account. But I want to say that sometimes you could be exposing yourself to, it's possible for you to get the same amount of risk and still get a higher return, So instead of if you're very risk averse and you just want a bank account, a money market investment can give you the same kind of risk, but give you a higher return.
When you talk about money market investment, kindly break it down a bit for the average person.
Let me start with unit trust. Unit trust is basically pooling funds together. So Moretti, you have 10,000 bob, Kabingu, you have 20, and Billy, you have 30, and we bring it together so that we're able to get a higher return. If you go to the bank with 100,000, the best rate they could possibly give you right now would be 2% or 1% return per year. But if we go to the bank with 100 million, they can give me 10% return. So unit trust investment is basically pulling funds from different people, putting it together so that you have a large pool of money. And with that large pool of money, you're able to make different investments and ultimately give a higher return compared to someone investing as an individual.
So these unit trusts, so it's essentially what you guys are doing, right?
Part of what we're doing, yeah.
Okay.
So the unit trust can then be invested in different ways. You could have a unit trust that primarily focuses on fixed income assets. You could have a unit trust that primarily focuses on equities. You could have a unit trust that primarily that is balanced, that has both fixed income and equities. So just depending on your risk appetite, then if you're risk averse and you want to protect your principal investment and then get a decent return, then you can put your money in a fixed income unit trust. If you are willing to take on more risk, you can put it in an equity unit trust. If you're more balanced, you can put it in a balanced unit trust. So within unit trust, you can have a different investment objective. So depending on the asset classes, but the one that is easiest or the one that has most investors' favor would be a money market unit trust.
Okay, before you proceed on to the money market fund, what is the average return on unit trust in the Kenyan market?
So right now it would be about between 9 and 10 per year. And by the way, that's really good. Most people, when you hear 10%, you would think that's very bad return. But the reality is, in developed countries, you have bonds yielding 2%. So
even negative interest in the US.
But that wouldn't be an investment I would encourage anyone to. So my question.
Anyway, so I want to say that 10% is really decent return, because remember, we're not talking about an investment in an Uber or a cow or this other business that require a lot of your time. We're talking about lazy investing. Yeah, just putting there, money somewhere and it earning you a 10% return.
So now let's begin before you break down the different kinds of unit trusts. So you've mentioned I think 3 types of investment with a unit trust. So I want us to begin from, first of all, for someone who does not know what unit trusts are, you've explained what is the gist of them. So where do I find this? Zinakwanga kinoo zinauzwa kwa duka.
Unaenda pale River Road. Unaenda pale River Road unaambia.
Nipateni unit trust tatu. So like, where do I find them? What are they?
Again,
and if I wanted to invest in a unit trust, where do I begin?
Okay. I would say simple Google search and search unit trusts in Kenya. You'll get a list. Once you get a list, you can reach out to any one of them that is of interest, and you know, the process of setting up is very simple. And I think I really encourage people to go the unit trust way, because you're essentially outsourcing investment services. So you'll get someone who sits and their day job is managing investments. So they have the professional know-how, and they're basically managing your money for you. You're outsourcing that. I am a big fan of outsourcing. If I want to build a house, I'm not going to try build it myself. I'll get an engineer and an architect, and
you must
whoever.
be very rich.
Yeah, money is all I have. But yeah, so just I'm a big proponent of outsourcing. If you do not have the time to look at investments every day, if you don't have the time to follow markets every day, you're better off putting your money somewhere where you know there's an investment manager who's a professional who's going to do that for me. So a simple Google search will show you how many, like the available investments. And then it's as simple, setting up your account is as simple as setting up your bank account. The way you went to a banking hall and you opened an account, it's that simple as well. Nowadays, in fact, you do it online, you know, a lot of that work is done online. Yeah.
So can you name a few reputable firms that are offering unit trusts? Yeah, because most Kenyans are afraid of being scammed.
Yeah. So it's also very important to make sure you're going with a reputable firm, people who have a track record, and people who are giving you reasonable returns. When I talk about a track record, you want to make sure that these guys have done this for a satisfactory period, for a
long period.
Yeah.
Sufficiently.
So if someone has started and has done this for 2 years, well, it's all relative. So if there's someone who's done it for 10 years, I'd have preference for the person who's done it for 10 years relative to someone who's done it for 1 year. So it's relative. So you want to go for someone who has track record. You can look at the funds that they've managed and the returns that they've been giving to their clients. So track record is very important. And then number 2, you also want someone who has a strong balance sheet as their back, or the support or the sponsor of the unit trust or whatever. So if you're going for, because that's, I think, the thing that differentiates, because if I wake up today and decide I want to run a unit trust, I'll manage your funds, but I could also lose it, right?
Yeah.
And if I lose it, there's
suboptimal.
no way you can take me. I don't have a lot of money. But if I go with a big institution that has a strong balance sheet, if they lose my investment, chances are I might be able to get some of that back, because they are a big company and they have assets themselves. So you want to go for someone who has a track record, and you want to go for someone who has a strong balance sheet, and you also want to go for someone who has a reasonable return. If the market is giving you between 9 to 10% and then someone else promises you 18%, you question, you question, what are they investing in? And even if they tell you what they're investing in, you sleep with one eye open, because it's too big a differential. If everyone else is giving you a maximum of 10% and this guy is giving you 18%, then that's a problem. So you want to make sure, I would say those 3 things are very important. Someone who has a track record, someone who has a strong balance sheet, and someone who's giving you attractive yet reasonable returns.
Okay.
Yeah.
So you did not answer the question. I see you trying to be very political about it. So when you talk about reputable institutions, you talk about like these big firms like Kina Sanlam and CFC or...
I'm actually just going to read you a list of unit trusts in Kenya. The newspaper publishes weekly prices. with different unit trusts and whatever rates they're offering. So that could be a good starting point. I could mention, maybe I'd actually just mention the top, the ones that come to mind, the largest, the Sanlam Money Market Fund. Then there's
no bias there.
there's CIC, there is Britam, there's UAP, Old Mutual, there's ICA Lion. So
those are the,
and then there are many more.
The smaller ones, the ones that you're saying someone should
just be careful.
Just
be careful.
Okay.
Just be careful. I'm not saying that they're all bad. They're not all bad, but just be careful as you invest. Because everyone starts from somewhere, right?
Definitely.
It's just that I'm not willing. If I'm going to put money in a money market instrument, that is to say I don't want to take on a lot of risk. So I'm also not going to be willing to put a lot of risk in a startup.
Yes,
sorts.
Definitely.
Yeah. So it depends on where you're at. If these guys are giving you a really good return and you believe in them and you can afford to lose that money, then you can go ahead with it. But if you're going into money market, you're essentially going into a low risk investment. So make it even less risky by putting it in a reputable firm.
Okay. So now you've talked about unit trusts, and I'm sure the moment you decide to invest, this for our listeners, you should be able to ask your provider the different options that exist and the risk levels that exist with whichever, I would say, profile that you want to work with. Money markets. So what other investment, I would say, plan exists?
You could go directly and buy bonds yourself. So unit trusts invests in all these asset classes, but the difference is that they pool funds from different people, then they invest it on your behalf. You could go the way where you do your own personal investments by buying a bond directly from the government, or buying a treasury bill, or buying stocks in the stock market. But before we get to that, there's something that we need to be cognizant of, the risk return slide. So high risk, high return. In the available asset classes, on the very up end where you have high risk and high return, but also possibility, well, when I say high risk, I mean there's high possibility of losing your money. It would primarily be on equities or your venture. Well, just basically equity investments.
What do you mean?
Can give you.
Explain now what you mean
Safaricom,
by equity.
EABL, where you go to
shares.
Shares, where you go to a broker, you open an account, and then you're able to buy shares and sell them however you choose to do it. So you're doing it yourself. There's a possibility of you making a lot of money on that, but then there's also a possibility of you losing your money. So for example, if last year you were invested in the stock market, our market did negative 8.6%. That means you lost. Yeah. But so far this year, we're already up 21%. That means if you invested at the beginning of the year, you're up 20%. So there's a lot of volatility. There's possibility of you gaining a lot, high return, but then there's possibility of you losing a lot, there's possibility of you gaining a lot, and there's possibility of you losing a lot with stocks or shares. And then on this other side of the slide, the lower end, there is low risk, low return. Your money market investments, your bonds, basically your fixed income investments, where you put in money and then you get interest every so often. And then at the end of the period, you get your principal investment back. So you're not taking any risk on your capital investment. If you put in 100, upon maturity, you should be able to get 100, but within that period of investment, you are getting regular interest. So you see, like there's very low risk, but then there's also low return. But then the decision that you have to make is the low return that low? So for example, if a money market investment is giving me 10% and there's possibility of making 20% on equities, but then there's also possibility of losing 10% on equities, is this money market 10% return very low? So that's a decision that you personally have to make.
No, that's what you were talking about when you said your risk tolerance,
yes,
so to speak.
Yes.
And then, so you talk about money markets. Explain what money markets are to the average illiterate economists.
Economists.
Oh no,
An economist cannot be illiterate.
Okay, no, I'm saying to someone who, when it comes to economics, they don't know what money markets are.
Again, they are pooled funds where we've pooled money from different people, put them together, and then invest them in different asset classes. So, but for money market, it's primarily focused on fixed income investment. That is to say that there's a huge emphasis on protecting your capital. So your principal investment will be protected because we're primarily investing in assets that are interest yielding assets.
So sorry to interrupt you. So when you compared that with
so under
with
money
unit
market,
trust,
actually, so we have regulations that govern money markets or govern such investments in our country. So we have like the Capital Markets Authority that has come up with CIS regulations, the Collective Investment Scheme regulations, and you have to abide by that. So they give you which asset classes that you can invest in. So for money market, you can invest in bonds, both government and corporate. You can invest in deposits. The difference between you investing in a deposit and a money market investing in a deposit is basically scale.
The scale. So
they
the
can
interest
put
is higher.
$1 billion in a deposit and they'll get a good return. You'll put a million
20K,
and you might not get a good return. So there's bonds, both government and corporate, then there's deposits. And that's basically what can be invested in a money market investment.
So when you compare that with unit trust, then so what's the difference?
So a money market is still a unit trust investment. So you have a unit trust investment, you have unit trusts, which are basically just pooled funds.
Oh.
And then under that it can be a money market unit trust. It can be a fixed income unit trust where it majorly invests in fixed income assets, with very low allocation to deposits. And then you can have equity or stock unit trust.
So depending
and the major
on the risk.
thing,
the risk
and the
return.
the biggest difference for money markets are very comparable to deposits in that you can get your money in and out as you please. You can put in money.
Liquidity.
Yes, they offer liquidity.
So if I invest my money in a market, in
money market?
in money markets, so what you're saying is that as compared to a SACCO, for example, where you have to give, this GMA
For 60, yeah.
So hapa you're able to withdraw your money on
Yes.
demand.
Yes, within
Together-
3 days.
together
Within 3 days
yeah.
for most of this. And when I say within three days, you can, sometimes it's actually the next day. So they offer you liquidity. And because they offer you liquidity, they're also limited in how they invest. That's why all their investments have to be primarily deposits, corporate bonds and government bonds, only.
Basically short-term assets.
It's
So
just
money
a
markets ni chama,
chama, except
it's a larger scale.
except now, most chamas are merry-go-rounds.
Yeah.
This one's not merry-go-round. This is a chama where you put money and it is invested, then you get returns.
So it's like a merry you round. It's your money. Okay,
It's
that's
our
stupid.
money we invest.
Yeah.
Yeah.
So just to kind of demystify a bit more, to get a bit better clarity. So money markets, you have just like you would in a SACCO, you invest money. They invest the money for you. I think the profit mnagawana with the farm, and you're able to withdraw your money whenever you want it. So that means the returns also are not very, very high, but they are. First of all, I think the best take I have from this is that you are able to recoup the inflationary value. It's higher than inflation. So essentially you're not losing money.
Exactly. You're not losing value.
You're not losing value for your money. And then, so now, in terms, what would be your opinion when it comes to keeping your money in a SACCO?
Again, it depends on what you want. It depends on your position at that particular time. If I have a lot of money, because the thing that SACCOs do is they give you borrowing power, right? Something that a money market investment cannot give you. Again, just to remind you, money markets compares well with deposits. So that's the basic. You want to money market investments and deposits are very similar in terms of liquidity, except you just get a higher return. So you're able to get your money in and out as you please. But that's basically it.
So instead of keeping your money in an account
Yes,
where it's
you put
losing
it in a-
value,
yes.
put it somewhere, at least in a part of interest.
Exactly.
So it's just basically the same.
Yeah.
Yeah.
But Sasa, SACCOs, it has an advantage. It gives you borrowing power. You put in money and you're able to borrow sometimes even up to 5 times with different SACCOs. And then you also get some dividend.
Low interest also.
But you get some dividend, which can be good sometimes can be bad. So there are SACCOs which, for example, last year paid 4%, and there are SACCOs which paid 8%. So
My SACCO paid 12.
yeah. So depending on the type of savings that you have, because yeah. So a SACCO gives you that borrowing power. Sometimes can give you a high return, but you don't have access to the money. The only way you can access your money in a SACCO is if you close your account and take all your money out and leave the SACCO. And even then, you have to give them a period notice. Most of them, it's 60 days. So just know that when you put your money in a SACCO, you cannot access that money unless you're leaving the SACCO, or the only way you access your money is taking a loan from the SACCO. So it gives you that advantage in that it gives you borrowing power, but then it doesn't give you liquidity. A money market, on the other hand, gives you liquidity, does not give you the borrowing power.
The thing I'm understanding with these money markets is the fact that we have all these things that you can invest in. I can invest in shares. I can invest in bonds, government bonds. I can invest in whatever. But money markets makes sure that I don't need to know the technical details of those
Absolutely.
things. I don't need to take the time to be watching a screen somewhere. There's a guy doing that for me. But now, for those people who would want to
do that,
to do it themselves, right? For people who, because I'm sure when you do it, of course the returns might be higher because the risk is much higher because you don't have technical know-how. But if it works out, the returns will be higher because you're not sharing the profits with some organization. So now, what do you think?
Actually, we don't share profits. You're charged a percent of your assets.
That
so
is
if you've
sharing
put
profit.
no, because we can make a loss and you still pay us.
Oh.
Yeah. We can remove that. But what I want to say is it's assets management fees, investment management fees, which are pegged on the assets that we are managing. So if you've given us 100, the fees vary. So it can be 1.2% of the assets or 2%. But I think the most I've seen in our market is 2%. But then when I quote the return of 9, for example, most money market funds give this as net of fees. That means we've already charged our fees, but we're still giving you a 9% return. Yeah.
Ah, okay.
So now let's go back to someone who wants to do it themselves. But of course, let me mention that even if you want to invest in bonds, you can still get a pooled fund that invests in bonds. So you can still outsource that function. Even if you want to invest in shares, you can still get a pooled fund that invests in shares. But now your question is on people who want to do it themselves. So first, there's a lot of risk when it comes to someone who wants to invest themselves. You're basically taking on a lot of work because investment ought not to be mindless. There has to be research that goes into it. You have to look at different companies, study the trends, study the economy. There's a lot of work that goes into making a decision to buy a stock. So if you have time and you have the ability to do this, then you're welcome to do it. And if you have time to monitor the markets, then you're still welcome to do it. And there are people who've done it and they've made a lot of money on it. So the way to go about it is basically just go and open a stock brokerage account. There are many brokers in this country. Go Google stock brokers in Kenya. You'll get a list. Top of my head, well, I can think of very many. Kingdom Securities, Equity Investment Bank, AIB, Securities, Kestrel, Jengis. There are very many stockbrokers in this country. So you walk in, open an account, and then you're able to give them instructions. And some of these brokers actually allow you or give you a platform where you can do the trades yourself. So some of them you have to give them instruction via email and tell them, please sell 100,000 Safaricom shares from my account, and then they'll do that. Others will give you access to an online portal where you're able to do it yourself and even monitor the prices of the stocks, etc. So you can do it yourself.
So, but now the risk is much higher because you can get the same I would say advantage, the same utility of selling shares and buying shares without having to sit down behind a screen and scratch your head. You can outsource that function.
Mm-hmm. And we ought not to underestimate the amount of work that goes into making investment decisions. There's a lot of work that goes into you have to study the economy, you have to study this company, you have to study the management of this company.
Also.
You have to, there's a lot that goes into making these decisions, and there are people who this is their day job. So you, if you're an engineer, you're saying you'll go to the office, come back home by 8, and then between 8 and 11, you will sit down and study, first of all, before you make an investment decision. And then tomorrow, you wake up at 6 and then do a trade. It's just, it makes it a lot harder. But for people who have time, this is something that they can learn and possibly do.
Yeah, plus the markets close at what?
3.
Yeah.
So open at 9 and close at 3. So you, during your day job, maybe at lunchtime, find some time and go sell some Safaricom. I'm just saying it's much harder.
Yeah.
It's much harder.
So one would rather outsource that function to. So explain to me. I have some friends who had asked me how bonds work, what bonds are. That category of buying government and corporate bonds and bonds and is
bonds and bills.
And bills. Explain to us what those are and the differences between them and probably the risk profile and the return, the possible returns and the period of times that are required. Yeah.
So the major difference between treasury bond and a treasury bill is just the tenor or the time to maturity. Treasury bills mature within a year, and then bonds is anything above that, anything above a year. At issuance, because you can have a bond that's maturing in 6 months, but it was issued a long time ago. So at issuance, treasury bills have a maximum of 1 year to maturity, and then treasury bonds have longer than 1 year to mature. Within treasury bills, you have 3 different types of papers. You have a 1 year paper, 182-day paper, and a 91-day paper. Those are treasury bill papers. For government bonds, then you have over 1 year. We're talking 1 year, 2 years, all the way. I think the longest we have now is a 25 year. Basically, longer than all the way to 20 years, 25, 30 years even can be issued. So that's the major difference between treasury bills and treasury bonds. And of course, because of the time to maturity, then there's also a difference in terms of the yield. A treasury bill right now is yielding 7.4%. That's a 1 year paper. And of course, the 182 days yielding less, maybe about 7.2%, and then 91 days yielding less than that. But a government bond, which is longer than 1 year, will give you a higher return, higher than the bill, which is giving you a 7.4% return. The way to invest in a government bond or a government treasury bill, there's minimum investment amount of 50,000. And the way to do it is just go open an account with CBK, and then you should be able to start buying and selling treasury bills and bonds.
How about, can you mention the there was a mobile product for buying bonds, bills, but I think its limit was 2,000.
Yeah.
You could invest as low as 2,000.
Yeah.
Emakiba. Yeah.
I think it was as low as 3,000 bob when it was first launched, right?
Yeah. Okay, now on to corporate bonds.
Corporate bonds. Oh, yeah,
Yes.
It was the corporate bond paper. Oh, wait, but we haven't talked about the Emakiba, which basically, so there's minimum amounts that you can, there's a minimum requirement of 50,000, for example, for a treasury bill. But then for Emakiba, which is a bond that was issued by the government through M-Pesa, mobile, that allowed people to put in money as little as 3,000 bob, Kenya shillings, and it would give you a return of up to 10%, which was a really good investment. The other thing I want to mention, which is a huge, before we get to corporate bonds, which is a huge limitation, is liquidity. So a treasury bill will give you, so government securities are considered very low risk. The government, there is some risk, but it's low, right? So the government will pay will meet its obligations. We haven't had a time in our country where the government failed to honor its obligations. So government securities are considered relatively less, they are considered low risk investments. And of course, if you can remember, low risk, low return comparative to other asset classes. That's an advantage when it comes to government papers, but there's a huge limiting factor when it comes to liquidity. When you buy a government paper, you might not be able to sell it or get out of it when you need the money as fast as you might be able to get a money market investment. You get, like, a money market investment allows you in and out however you want. A government paper, you might not be able to sell it when you need the money unless you have a significant amount. So there's a limitation that comes with the amount of money that you've invested. The liquidity is limited, but it doesn't necessarily mean that the entire market's liquidity is limited. Our market is very liquid. So you will be limited depending on the amount of money you have invested. So if you have 100,000, just know you will hold that 100,000 until that paper matures after 20 years, and you'll be getting your regular interest income. But if you have 100 million, then you can easily get in and out as you want, because there's also another way of making money with government bonds. One, you get interest, and then number two, you can also make some capital gains depending on how interest rates behave. The value of a bond is inversely related to the interest rates.
Yeah.
So if interest rates go up, it means the bond value will go down. If interest rates go down, then the bond value will go up. So if you're holding a bond, then interest rates fall, then now the value of your bond is higher, then it's possible for you to sell that bond, lock in on your capital gains, and even maybe hold out or invest in something else, or wait for interest rates to go back up and then reinvest. So it's possible for you to make money out of trading in government securities, but the catch here is you have to have a significant amount of money.
So see 20k, 30k, 50k.
See 30k. Maybe, in my opinion, maybe at least 5 million. Anything less than that, you will struggle to make any profits. Anything less than that will mean you will be selling at a discount to the market. Because we have something called odd lots. Odd lots means anything less than 100 million. 100 million will get you the yield that is prevailing. Anything less than 100 million, any buyer will knock you off. Atakwambia, I'll only pay less than what the market is currently bidding for this because you're giving me less than 100.
Yes. And the fact that you're offloading them, that means you kind of desperate or something like that.
Or you want to make, or you want to, it depends. If interest rates have gone down and you've made some good money, then you can sell that paper, right? But again, remember, you have to have a significant amount for you to get a reasonable return.
So the common theme here is small players should focus more on stability of returns as compared to fixed income, fixed return assets.
I would, or to put it in a different way, if small players should not try to make money out of trading. It will be difficult. Small players ought to just put their money and get a regular return if you're doing fixed income investments. Don't expect to make any capital gains or losses if you don't have huge amounts of money, because you might not be able to sell it.
I saw some of the interest rates. One of the reasons why governments have been very, very careless with borrowing is because the interest rates for some unexplained reason, have been going down and down over time. Why is that, do you think?
The reason, at least I can talk about Kenya, because different countries have different things going on. So it's not a general theme in every country. Generally, in developed economies, we have low interest rates for governments. But in our economy, Kenya is a frontier economy.
Mm-hmm. What's a frontier economy?
It just means the level of development. So developed markets have it means the level of your economy, the growth of your economy, as well as the risks that people attach to investing in your economy. So, for example, Kenya is considered very risky compared to investing in the US for a US investor. For them, investing at home is low risk compared to here, where there are different kinds of risk: political risk, currency risk. So just it's a relatively high risk economy compared to developed countries.
Okay.
Yeah.
Okay. So it all depends on
Yeah, so different countries have different interest environment, but maybe let's be specific to Kenya. Interest rates in our country started declining when we had the interest rate cap law coming into effect. When that happened, if you remember, the government put a cap on the interest rate that banks could lend to the private sector. So initially, banks could give you money at 18-19%, but then the government said you can only give money out to the private sector at a maximum of 4% plus the CBR rate, which at that time I think was coming to 13%. Yeah, so that when you add 4%, you come to 13.5. So when that happened, many banks then preferred to give money to the government, because you would give money to Kabingu, for example. Kabingu has a business. That business is high risk. I don't know if Kabingu will make money or not.
He won't. Kabingu make this guy.
Yeah, so banks then preferred to, instead of giving Kabingu money, we'll give the money to the government. The government is borrowing every week through treasury bills and every month through treasury bonds. So instead of giving Kabingu money at 13%, I'll give it to the government at 10, 11, 12%. And so when we have a lot of money chasing the same securities, the interest rate on that security goes low, because it means exactly it's a demand. It's a function of demand and supply. So there's a lot of demand for government securities because now banks are not giving to the private sector, and that has played.
It's called the crowding out effect.
And that was a major contributor. That was the major reason why we saw interest rates decline. And we've seen it sustained, or the decline, we've seen that sustained over the last 2 years, even after this law was repealed, because the law was repealed in 2019, and it was so banks were now free to charge whatever they could, but they really were not, because there's a lot of work that goes into pricing a loan, and then CBK has to approve it, and CBK has not been proactive in doing that. And then the other thing is the government is taking money at very attractive rates anyway. So I'm still just going to give the government my money. So
even with the low interest on the bonds.
On the government. But you see, it's not low interest. It's not low. It's 10%, 11, 12%, whereas I was giving to Kabingu at 13%.
Kabingu is very risky.
Yes.
Very risky. Goodness.
And when I give money to Kabingu, I need to set aside, there's a capital, there's provisioning that I need to do based on the risk of Kabingu. So government is low risk. That means the capital that I'm setting aside is not a lot. So when you do that math, then you realize it's cheaper for me to just give the money to the government.
So Kwamboka, in summary, so for someone with 100,000 to 500,000, what would you advise them? From 100,000,
even 2,000, because the money market allows you to invest as little as 2,500. So I think my parting shot is this: don't put your money in a savings account. If you are saving money, put it somewhere where you will earn a higher return, higher than inflation, because in that way you preserve the value of your money, and you also get some additional return. So don't put your money in a savings account, put your money in a money market fund. And there are many available money market investments. And then the other thing I want to say is that there are different there are different funds that you can invest in. If you have a tolerance for high risk, you can put it in an equity unit trust fund. If you have money that you just want to lock away for a longer period of time, you can put in a fixed income unit trust fund. And then if you have money that you want to access the liquidity often, then you can just put it in a money market fund that will still give you a high return. And currently we have good money market service fund providers giving a return of between 9% to 10%. That's number one. And then also, if you have, again, I'm a huge proponent of outsourcing. If you do not have the time to stare at a screen every day for long periods of time, if you don't have the time to do fundamental research on companies, etc., then outsource these services and put it with an investment management company. However, if you have the time to do it yourself and you have the ability to understand a lot of the work that goes into making an investment decision, then you can also do it yourself by opening a stock brokerage account. If you're doing shares, you can do it yourself by opening an account with the central bank if you want to do bonds. And you can also do it yourself if you want to do a corporate paper or a corporate bond.
Okay.
Yeah.
So I think for me, I have... Sorry?
Oh, wait, one more thing. Mm-hmm. Money market funds or whatever pooled fund that you want to invest in allows you to top up. So it can be your savings plan, literally. You can be putting in 2,500 every month for whatever period of time that you want to do it.
And they also offer liquidity withdrawals.
Yeah, the fact that you're able to access the money just as you would in your account, only that this time now at least it's not, draining into the drainage system. What?
and one
You're
more
not
thing.
missing out on high interest.
Yeah. And I know it can be very daunting for you to decide, where do I put money first? Maybe I could mention this. What I've seen work for a lot of people is, packing up cash or saving up money, beginning with a money market investment so that you set up an emergency fund or just a fund that can allow you to meet your expenses if you were to lose your job, for example, or if you were to get sick or whatever. So that's where to start. Start saving up and start by putting that money in a vehicle that will give you a good return. And then once you've reached a certain amount where you feel, I have set aside an emergency fund depending on my expenses, then you can start branching out to higher risky assets. So if your monthly expenses for the next 6 months, for example, comes up to 200,000 and you've put that aside, then you can afford to say anything above that, I'm going to put it in shares. I'll put it in a bond. I'll put it in a corporate paper, etc., etc.
Actually, I think this episode has been very, educational to me. I think for the first time I've been able to understand the money markets and everything, and the fact that I do not have to, I can get the same utility by having someone else do it. Someone who knows what they're doing. We are not living in the 200 BC where you cook your own food to eat it, And so I think it's been a very useful to this episode. So now the next episode, I think we're going to be discussing a bit of the nerdy stuff, the nerdy side of investment. So stay around for that.
Oh, I needed to make a disclaimer. As part of the episode, maybe at the end, the opinions expressed are my personal opinions and not necessarily the opinions of my employer. But it's so, we could spend a lot of time talking about investments.
I've actually enjoyed it because at least I had opened a money markets account. I deposited for 3 months and then I'm like, you know what, when the statement, when you see the, like, send you a monthly statement and this, nimepata 200. I'm like,
In short, najua pesa you make up on ndani.
No, you can't make it. I was saving 10K.
That's a lot.
Yes, that's why I decided to stop.
No, but you
and then
have
I decided to
to.
stop completely.
But Moretti, remember that's money. Yeah, so remember it's 9% for a year. So it's 9% times 30 over 365 for that month. You understand? So it has to be, when I say, I'll give you, let's use 100. So 10% of 100 is 10. That means for a whole year, you'll be earning 10. But for the month, it'll be 10 divided by 12. Because now you have to factor in. Remember when you started talking, we talked about making a disclaimer. This is not an investment in cows or chicken. And some of these investments can allow you to multiply times 3, times 4, times 5. This is not it. And also, the risk that you're taking here is very little. Yeah, chicken, you can lose all of that in a day. For money market, your capital is
secured.
Protected, more or less.
Okay. Good. So
I also need to do a disclaimer. The opinions that I, Billy, have expressed are my own and not necessarily of my employer.
Also, me, I work for a beverage company, so the opinions expressed in this episode are most definitely 100% not.